continuing on with our analysis of expense, other expenses are sometimes broken out into a little more detail. And we look at, the first one is general and administrative. These are things that are not directly tied to production of product or service, meaning the volume. These do not connect to a volume specifically. That includes the personnel expense of selling the product and the administration of the firm, which includes IT, HR, finance. Then there's selling expenses. What does it take to sell? You need sales folks, you need a sales platform, marketing, traveling, commissions, etc. Then you have non-production facilities costs, office, legal, accounting. So there's a lot of expenses that go into a company, and they vary by company and industry. This is where you can't look at them in isolation. Again, the trend is important. There can be relationships back to revenue. For example, selling expense or marketing expense should have some relationship to the growth in revenue. So you might want to see it stay the same. So these are the ones we look at here, selling, general, administrative. But the next one is research and development. Now, companies really need to do research and development to develop the new product or service that is coming out. So we look at research and development in a couple of different ways. One, we look at them as research activities. This is where we're doing pure research, okay? And that's we're doing investigations, trying to figure out, we try to gain an advantage, new science, technical knowledge. And then we have development activities. And that's when you're taking the research ideas that you believe are feasible technically and commercially, and you try to develop them into a fully functional business line, either product, service, and you got to ramp that up. So that is a lot of work that goes into that, and that includes prototypes, pilot programs, until you're ready to do it. So we do look at the two, research and development. Obviously, if it's in development, it's going to move and start to impact profit much sooner than will pure research, because you've already got them down. You have cost associated with R&D, obviously the personnel cost of those doing the research and development, materials, equipment, intangibles, contract services, indirect. So a lot goes in it, but when we look at it, this is a key piece to look at relative to future growth of the company. If we see a company that is having a declining research and development cost, well, what's the future going to be like if they're not working on new ideas? Is it growing? What's the mix of this? Is there things in the pipeline that are going to give us optimism for what's going to happen in the future? So we don't want to ignore that. We want to make sure we understand what's happening with it. Other items? Well, amortization of intangibles, which we saw in the discussion on acquisitions. You saw that. But we want to find out when there are write-downs or special items, we want to know what were they and why. Okay? So you look at this and say, okay, we wrote down the value of our intangible. Well, why did we write it down? Because we had made a set of assumptions when we established it about its value. Based on what's happening, its current value has changed. A good example is Delta Airlines, which made an investment last year of about $1.9 billion in Latin American airline firm that went bankrupt. So there doesn't look like there's a lot of hope for it. So what is Delta going to have to do? They may have to write up that $1.9 billion investment they made. So we're going to see a lot of that over the next few months, next year or two, as companies go back to revalue the intangibles as we talked about. So we do want to understand what's happening there. When we get into taxes, there's the effective tax rate, and then the notes to financial has all the details. If we look, when you get to step 5, we'll have a more in-depth discussion on that. So the results of all the above items of revenue and looking at expenses, net income. So when you're looking at the income statement, to talk about the net income alone doesn't tell us anything. You got to talk about net income within the context of what's happening with revenue and expense. And we then use a few ratios to evaluate net income. How are we doing? We already talked about the gross margin. That is a key one. The next one is the net margin. Net income divided by sales. How much of the sales goes to profit? Okay, what's that net margin? So that's really net income divided by sales, which you should see right on your common size financial statements. We'll move into a few other measurements around net income, but net income focuses on its revenue, expenses, gross profit, net profit. When we look at some of the other ratios, they're more a function of how we have addressed capital, which we will also cover in another lecture. So if you have any questions, please let me know. And this ends step 4.